big moves here domestically with obviously global implications as well. But of course, you know that the Fed has been hiking interest rates to try to get inflation under control, even though, of course, the Fed's interest rate hikes can't really directly impact the major causes of inflation. But nevertheless, they continue down that direction in a very aggressive fashion. And we got new indications last week that they plan to 100% continue this course. Let's go ahead and put this up on the screen from the Wall Street Journal. So this is Lael Brainard, who is seen as more of a dovish figure within the Fed. She's the #2 policy maker, and she still is saying that, yes, at some point in the tightening cycle, the risks will become more two-sided, but she says that they need to keep going. If history is any guide, it's important to avoid the risk of pulling back too soon. Following a lengthy sequence of adverse supply shocks to goods, labor, and commodities that in combination with strong demand drove inflation to multi-decade highs, we must maintain a risk management posture to defend against the risk consumers and businesses will expect higher inflation to continue. So Saagar, she's saying full steam ahead. They are not changing course, even though there are some indications that inflation has come down, even though certainly gas prices have fallen, even though there are major risks on the other side of pushing the economy into a severe recession with massive impacts in terms of unemployment, in terms of, you know, consumer and just regular American pain. They still have no intention of changing course.
Yeah, absolutely. Senator Elizabeth Warren, who, look, you know, many disagreements aside, I think she's actually done a decent job when discussing the Fed. She was actually on CNN discussing this. Let's take a listen.
What he calls some pain means putting people out of work, shutting down small businesses because the cost of money goes up, because the interest rates go up.
So it sounds like you do think it's a mistake to raise interest rates again.
I am very worried about this because the causes of inflation, things like the fact that COVID is still shutting down parts of the economy around the world, that we still have supply chain kinks, that we still have a war going on in Ukraine that drives up the cost of energy, and that we still have these giant corporations that are engaging in price gouging. There is nothing in raising the interest rates, nothing in Jerome Powell's tool bag that deals directly with those. And he has admitted as much in congressional hearings when I've asked him about it.
There you go.
Yeah.
I think it's actually, I mean, look, it's true. He said it won't do anything about gas. The reason gas prices are down right now have much more to do with the Strategic Petroleum Reserve, which we were begging the Biden administration to release for months, and they've depleted about 1/3 of the SPR so far. By the way, I think that's fine. You know, we topped it up during the pandemic specifically for reasons like this, but that's the reason that gas prices have gone down. We'll go into that a little bit more. Same on food. I mean, food is dramatically impacted more by the supply chain, by natural by fertilizer rates, nitrogen, and by, you know, drought than it has anything to do with demand. Demand has, you know, some to do with it, of course, but that's the only thing they can control, and they're going after that. I mean, on the one hand, it's very difficult for me because I also see some companies which relied on cheap cash, like Google, for example.
Yeah.
Google has come out and they're like, well, guys, effectively Sundar Pichai is like, we need to boost productivity by 20%. Effectively admitting that cheap cash and was underwriting a whole lot of Google expansion and basically just like Google screwery.
Yeah.
That probably was the case at the very much on the corporate level. So some of that quote unquote tightening had to happen, but Google will survive. Small businesses, they actually may not survive. And the people with who unemployment impacts and all that, they especially are really hurting. I'm most worried about housing. I mean, the fact that the average mortgage rate continues to come up, I think it's like 6% right now, more than double, fastest rise in modern history, crushing the housing market. Housing market obviously needed to come down some, but you know, we also need new housing stock. And a lot of that new housing stock either goes on pause in construction or just doesn't get sold.
Yeah.
Which that's the other problem.
That's exactly right. I mean, it really is a complicated situation because on the one hand, the fact that you have had effective zero interest rates for so long, you have created this incredibly financialized economy, this like bizarre and unsustainable froth. Companies that really don't deserve to exist and aren't profitable, but because cash was so easy to come by, they could just continue and continue and continue. Massively inflating asset bubbles, which has been a huge driver of inequality, so that, you know, if you're someone who owns stuff and, you know, those prices kept going up and up and up. We didn't call it inflation at that point, but that's what was going on with assets and certainly with the housing market. So if you're on the lucky side of that divide, that was great for you for a lot of years. So on the one hand, yeah, it's inevitable and it's not a bad bad thing to pull that froth back, because that's part of what has been driving inequality. On the other hand, while, it was great for, didn't really benefit a lot of people on the way up, it was a small sliver, it is really, really going to be devastating if there's a severe recession. This all comes back to the fact that you have Congress and most of our government that is sort of unable to really act, that is stuck in gridlock, that is unable to be responsive to the needs of the American people. So, for example, Matt Stoller is floating, what you really need is higher rates for big companies to get some of this froth out, and lower interest rates for consumers and small businesses, so that they're able to borrow and do the things that they need to do, and be able to hire and expand and survive this difficult time. But unless there's some mechanism I am not aware of with the Fed, that would have to come through government congressional action. And of course, we're nowhere inside of that. So it really is very difficult. But the worst possible world is that you have continued inflation because you aren't dealing with those real problems, and, as Elizabeth Warren says, and you have a severe recession. That's exactly what one Fed economist is warning of. They don't want to talk about this, but this was a report, some research that was done here under the Fed's umbrella. Here, this is reporting from our friend Ken Klippenstein. He says Fed's own economist warns of severe recession from Chair Powell's rate hikes. That study, which was published back in July and sort of swept under the rug, was conducted by the Federal Reserve Board of Governors. And they're saying this is very reminiscent of actions taken by the Fed in 1920 that led to a severe recession. It was a very eerily similar dynamics. You'd just come out of the Spanish flu at that time. Of course, that killed 657,000 Americans. Many of those who died were workers. That meant there were more job openings than workers to fill them. So the surviving workers had more bargaining power. You had a tight labor market. What does this all sound like? You had rising real wages. The study doesn't mention it. Labor strikes were also proliferating that were spurred by that low unemployment rate. So a very similar landscape to what we're facing now. Also, like today, consumer spending was also recovering. Then, because World War I had ended, now, of course, because of the pandemic being over, despite the strong job market, inflation was also relatively high, and for similar reasons. The quote from the study says, at the end of World War I, the U.S. was experiencing strong growth and unruly inflation driven in part by an expansionary fiscal policy and accommodative monetary policy. That's exactly what we had now. We had low interest rates. That's the accommodative monetary policy. But we also had stimulus in the form of direct checks and other support during the coronavirus pandemic. So very similar things there. And what they said is in 1920, the Federal Reserve banks hiked their discount rates to tame inflation, and the U.S. economy entered a severe recession, now known as the Depression of 1920. And what they say in their warning here is that it's not that interest rates shouldn't be raised at all, but you've got to be really careful, because there's a delay between when you hike the rates and when the impact hits. And so if you just keep hiking and hiking and hiking without waiting to see how that's going to impact the economy, you can end up tripping the economy into a severe recession, because there is that delay in the tightening and how it hits. So that's what they're warning about.
Yeah, no, I mean, look, it's very interesting. I mean, their counter would be, the counter to that, right, is, well, we came out of it and we had the Roaring 20s. It's like, well, there was still a terrible a lot of people did suffer in 19. It took a couple of years for the Roaring 20s to really take off, and, not like things worked out all that well at the end of the 1920s. So it's not like the structural problems were fixed.
You wouldn't want to use that as your model to follow.
Yeah, exactly. It's like anybody who's pointing to any economic policy between 1919 and 1929 as quote unquote effective, probably not the best thing to do, and not exactly a path that we would go down. Look, the economy also is fundamentally different. The fact is that we're probably much more financialized today than we ever were before. So in a way, we may even be more vulnerable to rate hikes like that than before. And for how we come out of it and the possible ramifications of that, I'm really worried. I'm probably most worried about housing, because back then we didn't have the same level of housing crisis. You could quite more easily build housing if you needed to. There was a big housing boom all throughout, the post-1800s all the way up until even 1950s. So some of the supply constraints and plus we're much more globalized, vulnerable to major global supply shocks. I'm especially worried about Europe and the effect of their energy crisis as well. Not the only one. A lot of people are talking about it. Even apparently the White House this morning, there's a new report out that the White House thinks that one of their biggest fears is that the European energy crisis will bleed home and actually drive up the price of oil and will only continue inflation on the onward trajectory as rate hikes are going up. Another thing to remember, Europe also just hiked their rates by 0.75. So almost the exact same thing.
That's right. I mean, even the housing market thing is complicated because, as we covered before, there are a lot of people cheering for the housing market.
Yeah, I mean, it's
to
too high.
Because the prices are insane. First-time buyers have been completely priced out. Now, there are more effective ways to do that than crash the economy. The biggest one is to build more houses. I mean, that's one of the huge issues that we have is a lack of supply of housing and especially affordable housing, but really housing of all kinds. And hiking interest rates is actually counterproductive in terms of increasing the housing supply. That's number one. Number two, there's some impact from permanent capital buying up so many of the houses. I mean, we were talking about in some of these cities, it's like a quarter to a third of the homes being purchased are from private equity and other permanent capital. So that also is creating more demand and creating more competitive landscape where if you don't have that, the whole thing in cash or close to it, very difficult to be able to compete. You also have in some local markets the impact, which, is big picture positive, but can be very difficult in individual places where because of the work revolution coming out of the pandemic, where more people are working from home, working remotely, more people are just like changing their careers altogether and changing their priorities of life. You had some of these cities that if you're coming from San Francisco or you're coming from New York and you're moving into Boise or wherever, and you've still got your New York and your California salary, you're bidding up the housing prices locally and making things very difficult as well. So even with the housing market, it's sort of complex because, a lot of people would really like prices to come down, but crashing the economy. And by the way, when mortgage rates are very high, that also makes housing unaffordable. Not the best way to achieve that end.
That's right.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.